So there's a lot of pressure to buy something that you might not necessarily want to buy, but you have to buy because of the time frame.
So talk to us. Are you doing 1031 exchanges, and or what's your biggest frustration with that? And then of course we'll jump on the opportunity zone part of this.
We do not do 1031s, and a lot of our investors have chosen to avoid the 1031s and invest with us with the opportunity zones, mostly because of the fact that, one, you have to maintain the exact same structure and the relationship of the debt and capital stack, but also the fact that how much limited time frame that you have to identify it and then move into one. And so there's a lot of pressure to buy something that you might not necessarily want to buy, but you have to buy because of the time frame. With an OZ, we have a lot greater time frame because, let's say if you sell something, let's call it January 31 of the year, you have 45 days within a 1031 to identify, and then X amount of time to close afterwards. With an opportunity zone, you have the entire year to determine, and then you have to file your taxes. So then that determines what your real capital gain is, and then you have until June 29th of the following year to fund the zone. And then once the zone is funded, then we can apply it to a property. So you have a lot more time frame, and you can divide it. If you want to pull some of those capital gains and use it for other things, you don't have to use 100% of your gain all within the opportunity zone. You can delineate or choose where you want to put your money instead of everything all in one.
Yeah, it's speaking to the power of diversification and the power of time, right? Which to me, especially in a highly appreciated marketplace, those are your best friends, along with liquidity as maybe a next part of it, right? To be able to capture and purchase deals potentially at a discount. So that's interesting. And in the beginning, to me back up as well, you said you don't typically do 1031 exchanges because the whole entity must move, and the whole capital stack, debt capital stack must be, it's equal or greater value, right? Equal or greater debt, generally speaking, for 1031 exchanges. The other challenge too is you might buy a property for 10, put 2 million into it and sell it for 25, and your sweet spot is buying anywhere from 8 to 12, right? To do the value add. Once you get over into the 25 to the 30 or the $40 million deals, which is chasing the deals up, perhaps there's even more institutional buyers that are competing at a different scale, which can also make a challenge to actually make money on the deal. Can you kind of speak to just, buying the deal based upon the intrinsic value add, not buying it just to defer the tax?
Absolutely. I mean, that's our main strategy is, adding value to things. That's my role as a developer. So we're always looking to increase the value and get the appreciation that way. So, my cousin is a main REIT buyer, and he does it for unions, and all they're doing is looking for cash flow. And so they're buying cash, and they're willing to do a 3 and a 5% cap rate, and because that's the yield that they need to capture for their pension funds. That's, if you're trying to compete against that in terms of growth, that's a tough market to be building in. And so that's why we like, the product. I mean, that's another great point. When we're doing self-storage, we're at 10% of the valuation of multifamily. And so I can create 800, 6 to 800 units at 10% of the cost of multifamily. And so I can diversify and reduce risk dramatically because of that compared to multifamily.
That's a great point, especially with construction costs going higher and higher and higher, right? And a lot of challenges there. And by the way, I also want to touch on the 1031. I call it the shotgun wedding, right? The 45 days to get engaged, the 180 days to get married. And it's just not great. I was at Marcus and Millichap in 2006, and everyone's giving high fives when they were sellers. They hated to be buyers, but they didn't want to pay the tax. Then the music stopped, and I saw some lose half or all and had to dig themselves out the next 3 to 5 years. And one thing we identified was the 1031 exchange, right? They would not have purchased the property if it wasn't for the capital gains tax of 30 to 50%. And they felt trapped by that. And so they just kept doing it. And then they got hurt, right? Because they didn't have enough diversification, enough liquidity. They had too much debt. And so we quickly learned about a deferred sales trust in 2009. And we started to use that as a way to eliminate the need for the 1031 exchange. We actually just did it for a syndicator out of a $20 million deal out of Vegas. They sold a multifamily property. And they also don't do 1031 exchanges for all the reasons we talked about. but they put their GP interest into these trusts. And then they did another $16 million multifamily property, and the same thing. They put their GP interest into the same trust. They kept kind of piling it up, and then they can use the funds to go back into their own deals, all tax deferred. And I think it's the Netflix, the best kept secret to the commercial real estate world. Most people don't know about it. Some people get it confused with the Delaware Statutory Trust, which is another form of 1031. But I'm curious, have you ever heard of a deferred sales trust? And what I'm saying resonating with you?
I have heard of it, and we have not implemented it. We're in the expansion growth period at this point in time. And so, our model is to develop a portfolio of between $100 million and $150 million so that we can then liquidate it at that point in time. And so we're in the expansion. So when we get into the liquidation, then we will certainly be exploring those options.
Excellent.